Now friends, come to this particular page. This is your question ID number is 50 and this is your page number. Let me read the question. Question ID number 5050. X purchased a machine for Rs 3 lakhs on December 15, 2012. It is put to use on the same day. It is eligible for depreciation at the rate of 15%. He transferred the machine to Y on January 1, 2014 for Rs 2,20,000. Fair market value on that particular date is 2,50,000. Y uses the machine for his business purpose. Y again transfers it back to X on November 15, 2014 for Rs 3,10,000. Compute the amount of allowable depreciation and of chargeable capital gains, if any, assuming that this is only machine in the block of assets held by Mr. X and Mr. Y. Good question, friends. Go through the question. Friends, in this particular question, one of the points that should be noted and point that should be known to us is basically the meaning of the actual cost. Section 43.1. This particular section 43.1, basically defines that in different circumstances or different situations, what will be the actual cost to the assessee. However, most of the provisions of this particular explanation is pretty simple also. Like for example, amalgamation, demerger, etc., where the cost of the previous person becomes logically the cost of the successor. I mean, that kind of logical things have been put onto the statute record, and section 43.1, the definition of the actual cost is as such, friends, pretty, what should I say, a lengthy definition, but very logical one. And the important areas of that particular definition, let me bring it to your notice. First of all, friends, what should be noted here is Mr. X has purchased the machine. Listen very carefully. Mr. X has purchased this particular machine. Thereafter, he has transferred this particular machine to Mr. Y. Okay. However, this happened in 2012, but that doesn't mean that we always assume for our material that all the years the law is same as that of the previous year. So this particular year printed are all, what should I say, illustrative ones. So we are not trying to discuss that assessment year 13, 14, 14, 15, etc. We are doing our previous year only, because we assume that the law of all the years is the same, and that's a natural thing, because where it is a multiple year question, such things has to be there. So Mr. X sold it to Y, and somewhere on January 1, 2014, and after some time, somewhere in November 2014, Y again sold it back to X. Okay, so here original purchaser or the original asset owner is Mr. X, sold to Mr. Y. So logically for Mr. Y, this has become something like a second-hand assets. So under 43.1 explanation, there is one special situation which says that if it is a second-hand asset, that means if it was previously used by someone, then there is a treatment which is prescribed. That treatment we have to give for Mr. Y. Okay. Thereafter, again, when the asset goes back into the hands of Mr. X, that is a situation of reacquisition. That means the original owner was my own self. For some period it was sold to someone, and once again for some reason I reacquire that particular asset back. So reacquisition of the asset is one circumstances, and that is something which is again provided under 43.1. and that was, friends, this section 43.1 is a long definition, but few of the most valuable things I want to bring it to your notice. Otherwise it is very simple, logical and understandable. Okay, so first of all, let me just open up with my answer. Question ID number is 50. Okay, so I will just say Mr. X and Mr. Y, because I have to give the treatment for both of them. Okay, so I'll first original acquirer is Mr. X. So I'll just start with our standard format. Opening WDV, so that will not be there. Additions made during the year for that particular gentleman is 3 lakhs. This is all. I will just call it as a year number 1. Okay, so I'm not writing that 12, 13, 13, not required. I mean, I will symbolically say year number 1, year number 2. That means next year and next year, that way. Okay. Additions. Is there anything sold during the year? No, nothing has been sold during the year. Okay. So for this gentleman, there is no transaction, Mr. Y. So your WDV is 3 lakhs, on which you have to calculate the depreciation at the rate of 15%, but you have to check whether it is full year, that means full rate or half rate, sorry. And that will be based on our question data. First of all, he has purchased somewhere on December. So logically, December, January, February, March. So 180 days is the test, friends, for deciding half rate, full rate. So naturally, because of this is December acquisition and it is put to use on the same day, because that usage of that particular asset is always the condition. So this particular, if you want to write even the previous year, this is going to be your previous year 12-13. Okay, and in that particular year, it is going to be half the rate. Okay, so it is 15% and half the rate because it was December. Okay, so amount of depreciation is going to be 22,500, and your closing WDV is going to be 2,77,500. Okay, now the year number 2. Opening WDV, additions made, anything if it is sold during the year, same format. Okay, this is your WDV, depreciation, and the closing WDV. Okay, so what is going to be your next year now? Next year, it is eligible for depreciation. We have considered he transfers the machine to Y on January 1, 2014. So January 1, 2014 is basically your previous year 13-14. So that is your basically your next year. Okay, this date means previous year 13-14. So year number 1, that Mr. X has already purchased, and year number 2, that way you can say that it has been sold to Mr. Y. But in this particular case for Mr. Y, it is going to become a second-hand assets. Okay, where this Mr. X, who had originally purchased this particular asset, had used it for the purpose of business and profession. Okay, so now let us understand these particular provisions. Okay, so for these gentlemen, the opening WDV will be 277,500. For Mr. Y, there is no question of any WDV. Nothing have been added, but something has been sold for a price. Okay, let me just put the numbers first of all, whatever the data available. He transfers the machine on this date for a price of 3,20,000, and the fair market value on that particular date is 2,50,000. So actual selling price is 3,20,000. So 3,20,000. So for Mr. I'm just putting the basic number first of all, thereafter I will explain that particular expense. So supposing if I have to say this is going to become minus 42,500, but I cannot write minus WDV. I mean, this is only for our understanding purpose, friends. So basically, this is going to give rise to deemed short-term capital gains. Okay, so no question of debt. Normally, I mean, of course, then if I have to update, and this gentleman has purchased it for 3,20,000. So for Mr. Y, it will be additions 3,20,000. Nothing has been sold, and similarly, I would have been calculating depreciation for that particular gentleman. Okay. However, the question is for these gentlemen, this particular situation, whether this particular cost is going to be the same figure or it is going to be something else. Okay. Now, first of all, let me take up the Barrett provision for your better understanding. So this is your Barrett provision, section 43(1). This is your chapter ID number, page number, and everything. Okay. Now, under this definition of section 43(1), friends, different situations have been provided in form of an explanation, and different circumstances have been thought of. Okay. Now, Explanation number 3. Okay. Wherever there is a second-hand asset. So basically now our Mr. Y is going to come under the scanner here. Where there is any second-hand asset or assets earlier used by the other person for the purpose of business and profession. Okay. What does the law say? Where before the date of the acquisition of the assessee, the asset were anytime used by the other person for the purpose of his business and profession. So basically I am acquiring some second-hand asset, but what type of second-hand asset? The other person, that means the person from whom I am purchasing this particular asset, that particular person is using this particular asset for the purpose of his business and profession. Okay, so it is not like any second-hand asset in this particular category, but the type of those assets which the other person was using it for the purpose of his business and profession. Okay, and the assessing officer is satisfied that the main purpose, he is satisfied that the main purpose of the transfer of this asset directly, indirectly, was the reduction of the liability to the income tax. If he is satisfied that the main purpose of this particular transaction which is already implemented is to reduce the tax liability by claiming the depreciation with reference to the enhanced cost. That means basically what these guys have done, they basically I am acquiring a second-hand asset at an enhanced value because I am a purchaser of the second-hand asset, and if I do overvaluation, I get over depreciation. And that's the thing which the lawmaker has thought. So if I have purchased this particular asset at overvalue, okay, I mean that's the imagination. If I have purchased it at the overvalue, and if the officer is satisfied that the main purpose of this particular overvaluation is to just reduce the tax liability, that means basically it's something wrong that you have already done it. Okay, then the actual cost to the assessee, shall be such amount as the assessing officer may consider with the previous approval of the senior officer, determine having regards to the circumstances of the case. In other words, the value will be the fair market value, but this particular fair market value approach and fair market value concept will be applicable only when there is a non-genuine type transaction. That way we should understand. Now we have to look at the same to same situation here. Look at this. Okay, so Mr. Y has purchased this particular asset for 3,20,000, but for him, the fair market value as printed to me in the question is 2,50,000. Now, if I believe that 2,20,000 is a excessive valuation, and this discussion is only done with respect to Mr. Y because Mr. Y is the acquirer of a second-hand asset. So if I believe as an assessing officer that this is an overvaluation done only with the intention to claim higher depreciation, invariably to decrease your income tax liability, in that particular case, the fair value having regards to the circumstances, what the assessing officer has going to determine. So assessing officer may not accept the value of 3,20,000, but instead he may accept only 2,50,000. Okay, so I will cut this particular figure. If you want, you can write an assumption that assessing officer is not satisfied with the value and all that kind of situation. So assessing officer will not accept the value of 3,20,000, and instead he will accept the value which is 2,50,000. But you will think that will that affect the value of that Mr. X now? No. That's not going to affect, because Mr. X, the selling price of the asset is 20,000. So this explanation takes care of those person who is basically the acquirer of the second-hand asset. So don't believe that now I'm going to adjust the selling price of Mr. X also. No. That's not to be done. Okay. Now on this you have to claim the depreciation at the rate of 15%. Again, it will go for half the rate because this particular transaction was somewhere in the month of January. So 180 number of days test will come and you will not be eligible for full depreciation. Okay. And your amount of the depreciation will be 18,750 and your closing WDV is going to be 231,250. And for Mr. X, there is no closing WDV, reason being that that particular asset has been, in fact, that particular asset is already been transferred from the block, so no question of any closing WDV. Okay. And instead, there can be short-term capital gains. That particular point, if you want to write for Mr. X, you can write. But right now, we are discussing only depreciation, so I'm not focusing on the capital gains. Okay. Now, the year number 3. Again, the same facts. Opening WDV. Additions. Any sale price. Okay. You will get WDV, then the depreciation, and the closing WDV. Now the asset is actually there in the hands of Mr. Y. So for him there will be an opening WDV 231,250. Now Mr. Y is again selling this particular asset back to Mr. X. So this will be a case and situation for Mr. X now, who is reacquiring. I repeat, who is reacquiring that particular assets. Now see our normal situation first of all, that what is the price at which he is reacquiring. Let me see the figure first of all. Let me do it in a quick possible way. Now Y again transfers this back to Mr. X on November 15, 2014. So November 15, 2014 is going to be previous year 14-15. Basically the next following year. Okay. So I just call it as a year number 3. Now Y again transfers back for the price of 3,10,000. So for Y the selling price is 3,10,000. Okay. And for Mr. X the purchase price is 2,10,000. Okay, this is how this should have in the situation. And then again I get the WDV and then the depreciation, all that. But I cannot finalize my answer right now because I have to see that particular explanation of reacquisition. So baby, okay. The explanation number 4. Wherever the assets have been reacquired. So there is one situation of explanation 4 which talks about the reacquisition of the asset. Okay, where any asset which once belonged to the assessee, where any asset once belonged to the assessee, that means in the past, okay, and had been used by him for the purpose of his business and profession, okay, ceased to be his property by reasons of transfer or otherwise, is reacquired by him. So this is a clear-cut situation of a reacquisition. Then the actual cost to the assessee shall be. Now this is what this particular explanation makes it very clear. So the situation is of reacquisition and the actual cost shall be. Okay. The actual cost to him when he has first acquired as reduced by. So whatever was his original cost, when he was the owner of that particular asset, is reduced by the amount of the depreciation that would have been allowed to the assessee. So that means which would have been allowed to that particular assessee for any assessment year, as if that was the only asset in the relevant block. So it is like, supposing if you would have not transferred that particular asset, then what would have been the depreciation that would have been allowed to you? Okay. As if this particular asset was the only asset, then basically I logically call it as a notional WDV or the actual price for which it is reacquired by him, whichever is less. Whichever is less. So logically if I want to write, I will say that this is notional WDV or reacquisition price, that means the actual price, whichever is less. Now here there is some different people who interpret differently. I'll tell you that particular point also. Don't worry. Okay. Now see, for Mr. X, what is the actual purchase price that he has already purchased? That is 10,000. So that figure is already known to us, that his price which he has paid for reacquisition is 3,10,000. Compare it with what would have been the depreciation that would have been allowable to him. Okay, so what was his original cost was 3 lakhs minus your depreciation for that year number 1 was 22,500. Your depreciation allowed to him was 22,500 and his WD was 277,500. Okay, so to him the original cost was X amount, minus to him the depreciation was that particular figure. So for him the notional WDV is 277,500. So it is, comparison is 277,500 or 3,10,000, whichever is less. Okay, so I will not take the cost as 3,10,000, but I'll have to take 277,500 as the cost of Mr. X. So now it will be 277,500. On that I'll be claiming the depreciation at the rate of 15%. Again I'll have to multiply with half the rate. The reason being that again this particular transaction is somewhere in month of December, January, so 180 number of days test would not have been satisfied. So you'll be eligible for basically half the rate. And so just calculate, it is 20,813. Just use your calculator quickly, and this is 256,687. And for Mr. Y, it is anyway minus figure 78,750. But as I always say that don't write minus in the examination condition. That is only for our understanding. That means your sale price is greater than your cost, which means that it's going to be a short-term capital gains. Okay, so this is only for our understanding. So this Mr. Y will not have any closing WDV in the year number 3. Okay. However, now here, different people take different view and different what should I say, the school of thought actually exists here. See, the notional WDV which I have taken as 277,500, somebody also take it as depreciation for the year number 2. That supposing if this particular asset was already used by Mr. X in the year number 2 also, then what would have been the depreciation for that particular year if it would have been allowed to him. In that particular situation, they will reduce the notional WDV by the amount of the depreciation of the year number 2 also. So a different view or different opinion which also exists here is 277,500 minus the depreciation for the year number 2. Okay, so that could change your notional WDV. This is also the view which already exists. Is that absolutely clear? But the popular view is, I'll just go with my the final answer only. The popular view is that how much is the depreciation allowed to the assessee? Okay, so he has actually used it for year number 1. So what would have been allowed to the assessee was only for the year number 1. So I have considered only the depreciation for notional WDV calculation of the year number 1 by itself. However, the alternative view, the alternative opinion do exist also. Now let's go to the question and check it out whether anything that we are missing out. Okay, compute the allowable depreciation or capital gains chargeable to tax. We already done. If any, assuming this only machine in the block held both by Mr. X and Y. So we have already discussed the treatment for Mr. X and Mr. Y in this particular situation. Simple, and the answer is over. Okay, let's go to the next question now. Question ID number 51. Let me read the question. XYZ Limited purchased a machine on April 1 for 10 crores by availing 70% loan facility from the bank. The machine was acquired for extension of the business of the company and was put to use into effective production on February 1. The interest on loan is charged at the rate of 12% per annum. Advise XYZ Limited on the treatment of the interest payment made on this particular loan and depreciation allowable for that particular year. Assume that this machine is the only machine in the block of assets. MCQs. The total depreciation under section 32(1)(2) will be, your options are 80 lakh 25,000, 90 lakh 25,000, 1 crore 87,25,000, 1 crore and 15 lakhs. Total depreciation under section 32 will be, your options are 80 lakhs 25,000, 90 lakh 25,000, 1 crore 87 25 and 1 crore 15 lakh rupees. Okay, so go ahead with this particular question. This particular question is already testing your knowledge. See 32.1.2 and under section 32. That means 32.1.2 is basically your normal depreciation. Okay. And 32 would basically mean your total depreciation. Now, here we are not very sure whether it is manufacturing concerns or whether you will be eligible for the purpose of additional depreciation or not. But in that case, now a little bit of a, what should I say, gap, because we have only these options. No. Now see, considering the MCQs, you have to fit the data somewhere or the other. However, this particular question is not very much clear. Basically, that whether you are a manufacturer, because additional depreciation is only for the purpose of manufacturing concern or concern who is into generation, distribution of the power, etc. Otherwise, supposing if somebody is a trading concern, for them the additional depreciation provision, etc. do not apply at all. But let's read the question. XYZ Limited purchased a machine on April 1 for 10 crores by availing 70% loan facility from the bank. Now, 70% is the loan facility which you have already obtained, but what will be the actual cost of the asset is of course going to be 10 crores. Okay. However, that means it is partly funded through your money, it is partly funded through loan money. The machine was acquired for extension of the business. Now, it is just said it is extension of the business of the company. Now, extension of the business. It is not told to me in the question whether it is manufacturing of article or a thing. So that is somewhere things are little bit, and put into effective production. So this word production could give me what should I say, some hint that okay, you are into some sort of could give me some hint, and so I may think that okay, even additional depreciation, maybe not, I don't know. Okay. Now, interest on the loan is charged at the rate of 12% per annum, and they have already got it on April 1. So, whether the interest on capital borrowed, whether you have to capitalize with the cost of the asset, or the interest will be allowable to as a normal, basically it's a finance cost. Okay. So, in this particular situation, the interest on the capital borrowed, will be added basically to the cost of the asset if this was basically like prior to the asset being put to use. Okay, so that could be a thought in this particular question. 1 second, let me revisit the question. On April 1, purchased the machine. Okay, and it was put to effective production on February 1. So, your interest from April 1 to February 1. This much period interest, basically you should capitalize. So, I will say roughly it's about 10 months. Okay. The interest on loan charged is 12% per annum. So, just calculate how much that particular interest comes in this particular situation. Okay. So 70% is your loan facility. So your loan facility is going to be 7 crores. Alright. And you have 10 months and 12% per annum. Just use your calculator, how much you get it actually. Okay, so basically you are paying 1% interest for 10 months. So this 10 months you should capitalize. Okay, because 10 crore is the machine cost and 70% is a loan facility. So just do that particular calculation. Okay. Further, advise XYZ limit on treatment of the interest. So we have already advised. So if this was just not an MCQ and if they were to ask for the advice, we already given the advice that up to it has been put into the effective production. Up to it has been put, it should be capitalized with the cost of that particular asset. Okay. And assume that machine is the only machine in this particular block of assets. Okay. Let's do the calculation first of all. Question ID number 51. Opening WDV is not there. Additions made during the year is 10 crores of the actual cost. Interest, okay, 1% for 10 months on 7 crores. Okay, 7 crores, 1% is basically your 7 lakhs, and for 10 months, that means it's going to be 70 lakhs. That means it is going to be 0.70 crores because these figures are into crores. Okay, so this much interest should be capitalized. Your cost is going to be 10.7. Nothing has been sold. This is your WDV. On that, depreciation. Okay. Depreciation at the rate of 15%. This will be half the rate. Why? Because it was already put to production somewhere in the month of February. So you have used it during that particular previous year less than 180 number of days. So it's going to be half the rate. So 15% just multiply. It's going to be 0.8025. That is some 80,25,000. Okay. Additional depreciation at the rate of 20% multiplied by half. That will be on your actual cost, and your cost is 10.7. So 10%, so it is going to be 1.07. Okay. Additional depreciation will be under 3212A and normal depreciation will be under 3212, something like that. And your closing WDV is going to be 8.8275. This is how your normal working should go. Now let's come to the MCQs and see whether things are matching or not matching. Under 3212, okay. So under 3212, basically you want only the normal depreciation. So that is your 80,25,000. So our answer is A. The normal depreciation is 80,25,000 rupees. Now your total depreciation under section 32 will be. Now here that particular point could matter, because whether you will get the additional depreciation, not get additional depreciation, that could be a dicey point. And if you see this particular MCQ, you have this option of 80,25,000, that is your 3212 depreciation, and your total is 1,87,25. This figure also you have. Supposing in this particular MCQ, if these two figures, that means 80,25,000 and 187,25, if either of one figure would have been there, then I would have to select only one. Okay, so now this is the situation where there could be a little bit of a double mind in the minds of what should I say, an intelligent student. And I will go with the view that okay, because it is plant and machinery and looking at the circumstances, you are actually producing something. So basically you are manufacturing concern. I mean, that's of course a little bit of a guesswork, and my answer would have been C. So I would have taken this particular answer as like this, C. This will be my answer. Absolutely clear. That's the end of this particular question. This is on the assumption that you are eligible for additional depreciation. Now friends, one more, that way this particular question is already over. Okay, this particular question is already over. Now a point to be noted, a very valuable point to be noted. See, in this particular question friends, in this particular given previous year, you have got 32,1 2A depreciation at half the rate, and that amount has come to 1.07. Okay. The law says that in this year number 1, you have got half the additional depreciation because of that 180 number of days test, but the balance additional depreciation, that means the balance half, you can also get it in the next year. In the next year, I repeat, it's a very important point. You can also get the balance of the additional depreciation in the next year. Okay, so in the next year also, you will say you will get 32,1 that is your additional depreciation, which was not allowed to you in the year number 1 because of that 180 number of days test. That means you will get the additional depreciation 20% only, but because of this 180 number of days test, in the previous year you got half the rate, and in the next year, that means the subsequent year, you get, mamma mia, the another half. Okay, very important point. Now let me show you and bring to your notice these particular appropriate barrack provisions on this particular front. Okay, let me scroll a little bit friends, and mark this particular point as also very important, because on that also MCQ can be set on this particular front. Okay, now see, additional depreciation assessee engaged in the business of manufacture or the production of article or a thing. Okay, and because in this particular question it was already told that in the effective production, I mean, I've just taken that particular guesswork, and then I've thought that okay, this particular assessee was eligible for the additional depreciation. Okay, now look at this particular provision for that half the rate. One second. Pay maximum attention friends. Okay, where there is any asset, pay maximum attention darling. Okay, where any asset referred to in these clause 2A is your additional depreciation. Okay, which is put to use for a period less than 180 number of days, then you will get 50% of the amount calculated, which I call it as half the rate of depreciation. So your half rate concept, 180 number of days test, applicable to normal depreciation, plus it is applicable even to the additional depreciation. Okay. Now see the next provision. This was your one provision. This is your next provision, where the assets referred to in 2A. What is this 2A? This is your additional depreciation. Or the first provision of 2A. This is some of the backward areas, some specified areas where the higher rate of additional depreciation. So it is again the same to same situation. As the case may be, acquired by the assessee during the previous year and put to use for the purpose of period of less than 180 number of days. So your situation is that in the previous year you have already acquired, put to use less than 180 number of days, and therefore you are entitled to deduction with respect to 50%. Is that clear? Now the main point is coming. The deduction for the balance 50%. The deduction for the balance 50%. I repeat. Maximum attention required, friends. The deduction for the balance 50% of the amount calculated as the percentage prescribed under this particular clause shall be allowed under this subsection in the immediately succeeding previous year. It shall be allowed, I once again repeat, darling, the balance 50% shall be allowed under this particular clause in the immediately succeeding previous year. Mamma mia! So if your additional depreciation for test of 180 number of days was 50%, that means half the rate. Is that clear? In the next year, that means the immediately succeeding year, you can get the balance of the 50%. And this is what I already made a note here also. This is one of the points. In the previous year, you got half the rate because of that 180 number of days test. In the next year, so we can call it as immediately succeeding year. Technically, the law says immediately succeeding year, you get the balance half of the additional depreciation, and this is of course the incentive provisions. However, friends, one simple thing that you should remember, that you get additional depreciation only out of the WDV. That means you should have a sufficient WDV against which you will be taking this particular additional depreciation. So in the next year, I mean, we should be assuming that there is enough WDV so that you can get additional depreciation. In other words, the additional depreciation is allowed to you from the WDV. In other words, you don't get something out of your WDV as a matter of deduction. Okay, so that was one of the point, and that's done. Let's go to the next question. Question ID number 52. X Limited was incorporated on for manufacture of tires and tubes for the motor vehicle. The manufacturing unit was set up on April 30. The company commenced its manufacturing operation on May 1. The total cost of the plant and machinery installed in the unit is 100 crores. The said plant and machinery included second-hand plant and machinery bought for rupees 10 crores and the new plant and machinery for the scientific research relating to the business of the assessee acquired at the cost of 10 crores. Compute the amount of depreciation allowable under section 32. Furnish the explanation to support your computation. The total depreciation, this is your MCQ basically. The total depreciation under 3212A will be, your options are 1, 16 crores, 20 crores, 8 crores, 10 crores. Okay, fair enough. Come on, go through the question, thereafter I will discuss. X Limited is included for the manufacture of the tires. The moment you say that since you are for the manufacture of the tires, you will be eligible for the additional depreciation, subject to, of course, the condition of the additional depreciation, because additional depreciation is not available for specified kind of assets. So all those basic things should always be kept in your mind. The manufacturing of tires and tubes for the motor vehicles. So basically you are a manufacturing concern, so you are eligible for the additional depreciation. Manufacturing unit was set up on April 30 and the company commenced its operation on May 1st. So basically that half rate complication we don't have in this particular question. So if any depreciation we have to calculate, we have to go with the full rate. The total cost of the plant and machinery installed in the unit is 100 crores. So total cost, the total cost is 100 crores. The said plant and machinery included the second hand plant and machinery bought for 10 crores. So your 100 crores already includes your second hand assets also, which is 10 crores. Okay, and the new plant and machinery for the scientific research, so some plant and machinery for scientific research also relating to the business of the assessee acquired at the cost of 10 crores. So our 100 crores includes these 10. So it is something like 80 plus 10 plus 10. That's a breakup. Okay. Now the asset which you have got it for the scientific research are those assets basically for which you are anyway going to get the full deduction under section 35, because that is one incentive given under section 35 that I'll be discussing in due course of time, where full capital cost is allowed to as a deduction subjected to the conditions. So looking at the question, yes, it's a scientific research asset, eligible asset. So 100% deduction will be permissible. So if there is any asset for which 100% deduction is given under some another section, for the same to same asset, you never get the depreciation. Okay. So such assets are not eligible for depreciation. In other words, intention of the law is never to give you double deduction or double benefits. Okay. So these 10 crore is out of question, which is basically for scientific research. Now the second hand assets. The second hand assets are of course eligible. No doubt about that. Okay, for the normal depreciation, but the second hand assets are not eligible. I repeat, they are not eligible for what should I say, additional depreciation. In the additional depreciation, second hand assets are restricted. That means you do not get additional depreciation on the second hand assets. Okay, so basically the additional depreciation you will get it only on 80. Additional depreciation rate is 20%. In this particular question, it is somewhere in the month of May. So that half rate problem is not there. So 20% of 80. So your additional depreciation is straight away going to be 16, because question is asking you additional depreciation, which is under 32(1)(2)(a). So this is your answer in shortcut. Quickly. One of the point which I want to again repeat, in fact, I've already explained to you, but I want to repeat that again because I have the opportunity of that additional depreciation. Okay. So additional depreciation, friends, just look at this particular provisions 2A. Okay. Some of the assets, no deduction shall be allowed. Basically, you do not get the additional depreciation on some of the assets, and of that, if it was a second hand asset, basically this point number A itself, where any machinery or a plant before its installation by the assessee was used either within or outside India by another person. Basically it's a second hand assets. So if the previous person already used this particular asset, those assets whether in India or outside India, this is also you should remember, within India or even outside India, you are not eligible for additional depreciation. However, the second-hand assets do get normal depreciation. Have you understood that? They do get normal depreciation, but they do not get the additional depreciation. So, if I have to just do the working for this particular question quickly, however, not required because it was into the MCQ model, but because for our classwork purpose, let me do the quick computation. Opening WDV is not there. Add, you have 80, 10, 10. Scientific research asset, you do not get the depreciation because anyway they are eligible for 100% deduction under section 35. Okay, so this is 90. Nothing has been sold. This is 90. Okay, now your normal depreciation will be on 90. However, this particular MCQ did not ask us. But anyway, I just bring it to the normal depreciation. You will get it on 90. Half rate problem is not there. So multiply. This is going to be a normal depreciation. And your additional depreciation will be only on 80. Because your second hand assets are not eligible for additional depreciation. This is going to be your additional depreciation. And the difference, this is a closing WDV. This is how the computation was required to be done. If at all it was required to be done. But in the MCQ, we could have done that particular quick answering. And that quick answering, you already got the answer as 16 crores. That is your 80 into 20%. Now friends, come to this particular question ID number 53. X Limited transferred its fertilizer business to a new company, Y Limited, by way of a demerger with effect from appointed date April 1, after satisfying the conditions of the demerger. Further information is given. 1. WD of the entire block of the plant and machinery held by X Limited as on April 1 is 100 crores. Out of the above, WDV of the block of the plant and machinery of the fertilizer division is 70 crores. X Limited has brought forward unabsorbed depreciation of Rs 50 lakhs. On the above facts, you are required to explain the provisions of the Income Tax Act allowable to depreciation of the post-merger in the hands of X Limited, Y Limited, duly calculating the depreciation. And the MCQ option that you have is total depreciation for the year in the hands of the Y Limited will be A 35 crores, B 10.5 crores, C 45.5 crores, none of the above. Friends, it's a very simple transaction with respect to the demerger. The explanation 2A, 2B to section 43(6)(c), this is basically your WDV definition. Whenever this particular asset has been transferred in the scheme of the demerger, the WDV of the asset from the hands of the transferor company shall be reduced, and the same WDV shall be added in the hands of the transferee company, that is your resulting company. And when it comes to this unabsorbed, that is a brought forward depreciation, that is covered by section 72A4, and there also you have to apportion it, because if this particular brought forward depreciation is directly attributable to a particular unit, then I would have said that to that extent I would have transferred in the hands of the resulting company, but otherwise it has to be apportioned in the ratio of the asset as per section 72A. Okay, so very simple kind of the calculation. Understand the calculation how it is to be done, and thereafter I'll show you that particular simple provision, no big deal whatsoever. Okay, so you have Y Limited, you have X Limited. X Limited is the transferor and Y Limited is the transfer. Okay, so opening WDV, add if anything has been sold. So for Y Limited, basically it's a transfer, that means the receiving company, 70 crores they are receiving, and the transferor company you have to adjust by 70. So basically you remove from that particular block of the transferor company, add it to the block of the transferee company. Simple one. Okay. So nothing has been added for X now. So that's a total 70. These are all crores. So this is 30. This is your WDV. Depreciation at the rate 15%. This is going to be 10.5 crores and this is going to be 4.5 crores. Closing WDV 59.5 crores and this is 25.5 crores. This is to be done as per the simple explanation 2A and 2B to section 43(6)(c). I will show you that it's a very simple one. Okay. Unabsorbed depreciation. I'm not going into the technical details, but that is covered by section 72A, and that also you have to do it in the same ratio. And the ratio is 70:30 because that is the ratio of the asset which has been transferred. However, friends, if this particular 50 lakhs was directly supposing for the fertilizer division, then I am not supposed to use this particular ratio. I repeat, if for this particular 50 lakhs of unabsorbed depreciation, if it was directly relatable to the fertilizer division in the question, then I have not to use this particular ratio. If it is not directly relatable, because that data exactly is not given to me, if it is not directly relatable, then I'll have to use this particular ratio. Okay, so 70:30, so total is 50 lakhs, so it is going to be 35 lakhs and 15 lakhs. This is how the division will be done in the hands of the transferor and transferee company. And the total depreciation, that means including your unabsorbed depreciation and your depreciation on the block, that is going to be 10.85 crores, and here it is going to be 4. Total depreciation will be 4.5 plus 15 lakhs, 4.65 crores. Is that okay? This is how the actual working which is required to be carried out. First of all, let me show you this particular barrack provision. This is our explanation 2A and 2B. This is our explanation to section 43(6)(c). Simple one. Only to show you, this is your 43(6)(c), that is a definition of the written down value. And in that, this particular explanation 2A for the demerged company and 2B for the resulting company, where asset transferred in the scheme of the demerger, the demerged company asset shall be reduced by the WDV. Okay, so that is one very simple one, so no need to go into that particular technical details. And in case of a resulting company, the written down value of the transferred asset immediately before that particular demerger. Is that clear? Now let's go to the MCQ. MCQ is saying that the total depreciation. Now they are asking for the total depreciation. Now this total depreciation probably is your unabsorbed depreciation and plus your current year depreciation. So unabsorbed depreciation plus the current year depreciation would be a total depreciation. If you see section 32.2, listen very carefully. If you see section 32.2, the carry forward set off of that depreciation, it says that the brought forward depreciation is deemed to be the allowance of the current previous year. So logically, your brought forward depreciation has to be totaled up conceptually by the amount of the current year depreciation, and accordingly you get the total depreciation. So basically this total depreciation should be interpreted as whatever is a normal depreciation plus this particular share, whatever unabsorbed depreciation. So unabsorbed depreciation, whatever allocation is coming to the transferee company, that should also be considered appropriately. However, this particular MCQ is asking you for the Y limited, and Y limited is basically the transferee company. I mean, general understanding, general interpretation, I'm just trying to tell you. So our total figure that we should look for in this particular MCQ is 10.85 crores. This is the total figure that we are looking for. Let's check whether we have it in the option or we don't have it. We don't have that 10 point. So the answer is going to be none of the above. Is that clear? Now, here somebody could have selected in the MCQ, friends, just to bring it to your notice, the next probable point would have been this particular point. That is a 10.5 crores. This could be a very kind of, this particular number. Could be. I mean, many students could have taken that particular point, but I think that that particular answer will be a wrong answer. That is not going to help you, because they have clearly asked you the total amount of the depreciation. They have asked you the total amount of the depreciation, which should include the amount of your unabsorbed depreciation. And that particular one of the point, as a matter of concept, I want to bring it to your notice, because without that your concepts are not so clear, darling. So one second, see, this is my section 32.2. okay, this is my section 32.2, which is basically carry forward set off of the depreciation and all those kind of figures, okay, where the full effect cannot be given to any allowance, where the full effect cannot be given to any allowance of that particular depreciation. It shall be added to the amount of the allowance of the depreciation in the following previous year and shall be deemed to be the part of that particular allowance. Basically, it shall be treated as deemed to be the allowance of that particular year. Okay, and if that particular year, that means the second year also, you are not able to absorb it, then similarly you have to add it to the allowance. You have to add it to the allowance of the subsequent year, and so on and so forth, succeeding previous year, and it shall be deemed to be the allowance of that particular previous year. In other words, friends, carry forward set off of the depreciation, each year it is deemed to be the allowance. That means even the carried forward depreciation is conceptually the deemed allowance of that particular previous year. It's a very conceptual thing, and accordingly, if there is any carried forward set off of the depreciation, it should be added to the current year allowance. This is added to the amount of the allowance. Is that clear? And that's the reason in this particular MCQ, friends, if somebody would have selected the answer as 10.5 crore rupees, which was in fact the most prominent number which maximum students could have selected, I think it will not be a correct answer. However, some teachers may even say that it's a correct answer, but I would not like to suggest and go with that answer of 10.5 crores. I would go with the answer strongly with none of the above. Okay, so let's go to the next question now. This is it. Let me just check the working, everything I've done, the total depreciation. Okay, I've already done that. Fair enough. Let me go to the next question quickly now. Question ID number 36. A car purchased by S on 10th of August of the preceding year for rupees 25,000 for the personal use. It brought into the business of the SSE on 1/12 of the previous year when its market value is 1,50,000. Compute the actual cost of the car and the amount of the depreciation, assuming the rate of depreciation to be 15%. Now friends, this particular point, let me tell you, it is a bit controversial point. In fact, this is also one of the very old examination question only. But to be very honest, friends, I'm personally not satisfied with the answer here. I'll tell you the reason. But before that, let's check out the answer. Okay. The situation here is that there is some asset. Previously, it was used for the personal purposes. Now it is been used for the business purposes. So what happens is, for example, it was many such example may come into picture. See, there was one of my personal computer which I was using it for personal purposes. Later on I qualified and now I am going to use the same personal computer for the purpose of my profession. I had one premises which was idle. I had nothing to do. So it was my personal property and I was doing nothing with that property for years and years. One fine day I decided to do some business and I decided that okay, that particular property I will use it for the purpose of my business and profession. So the situation is that asset is the same only, but the asset, the use of the asset is changing. Previously it was personal and now it is going to be a business use. Okay, in that particular situation, we have an explanation in section 43.1 which takes care of this particular situation, and even our next particular question is on the similar lines only. But let me handle this particular question first. And explanation to section 43.1. 1 second, let me scroll a little bit. Okay, this is your section 43.1, meaning of the actual cost. In this, you have this explanation. Okay. Okay. Explanation number 5. Where a building previously was the property of the assessee, where a property being building was previously the property of the assessee, brought into use for the purpose of business. So it is like it was a property of the assessee, but now it is brought into the business use. Previously it was probably your personal use, probably. Okay, so it's like your use of the property is changing. This is what this particular explanation is trying to say. Okay, in that particular case, the actual cost definition which is provided is the actual cost of the building to the assessee as reduced by the amount equal to the depreciation calculated in force that would have been allowed. So basically we call it as a notional WDV. So whatever is your cost minus the depreciation that would have been allowed is going to be the actual cost of your particular asset. Is that okay? But as I told you that I'm not satisfied with this particular answer and this particular question also to an extent, because this particular explanation applies only to the asset category being building. It does not apply to the other category of the assets. But what the people do, they apply this particular explanation even to the other category of the assets. If you see in this particular question, friends, 1 second. In this particular question, it is the same concept that previously not used for business, now used for business purpose, but it is for a motor car. So conceptually, friends, the explanation that we are trying to discuss do not apply. I repeat, do not apply to this particular motor car. But the maximum people will give the answer. This particular, what should I say, the answer as per the explanation number 5 only. Okay, so let me just do that and thereafter I will write a comment. So question number is 36. Question ID number is 36. Yes, I'll just say year number 1 because that asset was acquired in the preceding year. Opening WDV, add anything if it is sold. So previous year, that means preceding year, no opening WDV. Motor car was added for motor car. So this is a block of motor car. Nothing was sold. It was 3,25,000. Okay. Depreciation for that particular year, if it would have been allowed at the rate of 15%, just check half rate, full rate, whether any such data has been given to us in the question. Let me go and check. It was on the 10th August, so it will be anyway full rate. So no such problem of half rate, full rate. Okay. So this is going to be 48,750. Your closing WDV, if it was used for the business purpose, what would have been allowed to you? That is the working that we want to do. So this is going to be 276,250. This happened in the preceding year. Now in the previous year, you want the cost of that particular asset. Okay. So you will do opening WDV now. So you will not say that you have any opening WDV, because the previous working that I have done is only the notional working. Okay. So opening WDV not there. So during the year, say that I have add. Okay. And I will say that I am adding 276,250. Anything sold? Nothing has been sold. So 276,250. Depreciation for the current year. This is your actual cost definition. This is your definition, the explanation to section 43.1. Okay. Now in the current year, friends, it has been introduced. Once again, it has been introduced on 1/12 of the previous year. That means in the current previous year, you have used it for business purpose from 1st of the December. So it should go for half rate of depreciation in the current year, if at all any. Okay. So if at all you had to calculate, but actually the question not specifically asking, but let's check, compute the actual cost of the car and the amount of, okay, it is already asking the amount of depreciation. Assuming that the rate of depreciation is 15%, so it should be 15% multiplied by half the rate. And I'll get some amount of 20,000 and some odd number. Just check the calculation. You can do it by yourself. I think not a big issue. You will have a closing WDV. Okay. Now, here is something what I want to write a note now. Okay. So do that particular depreciation calculation by yourself now. And that particular note which I want to write here is the explanation number 5. Actually, this particular answer has been given as per explanation 5, but conceptually, I cannot use this particular explanation. Conceptually, I cannot use this particular explanation, but maximum people, textbooks, authors, everyone has done it like that, and maximum even professionals do it like that. So I'm just following that. Okay. So I'll just write a comment for that. I will say that the above answer is based on explanation 5 to 43.1, but it is controversial. Alternatively, somebody could have taken the cost as the that fair value what is already printed in the question. Somebody could have taken that particular view also, and see, that's the reason this particular question has already told you when the fair market value was this particular figure. And why this particular fair market value concept? Somebody could have taken the view that this is a situation of something like second-hand asset, but that is also not a clear situation. So this particular point is a bit dicey point, and I would say this is a controversial point. So somebody could have taken this as the cost as an alternative answer. So you need to just give that proper notes in the examination condition. But maximum, if you will see this particular answer in the past suggested and everywhere, those places also, they have used explanation 5 for the purpose of giving their answer. Let's go to the next question. Question ID number 37. Dr. Kalpesh Sanghvi purchased a house property 2 years back in January for 10 lakhs till 1/5. That means first month of the previous year it was self-occupied as residence. On this date, the said building was brought into use for the purpose of his medical profession. What would be the depreciation assuming that he owns no other building? Another house gifted to him by his father who had purchased the same 3 years back in the month of the May for rupees 9 lakhs. This got basically two property. One is the gifted property. Other is the property which was purchased by him, but he was using it for his personal purposes, and now he's going to use it for the business purpose. So previously it was self-occupied, and now it is brought into use. So this particular situation is straight away a situation of explanation 5. In fact, this is more better question. This is more better question. So this particular house property is a perfect situation of explanation 5 to section 43(1). Is that clear? So I have, and another property is something which was gifted to him by his father and same 3 years back. Okay. So that first of all, let me take you to that barrack provisions with respect to the gifted properties. 1 second. Okay. Here is what we have. Explanation 2 to section 43(1) with respect to the asset acquired by means of gift, will, inheritance, as the case may be. So it is a simple one. The actual cost will be the cost of the previous owner as reduced by the depreciation that would have been allowable. So in other words, it is simply your notional WDV. So you just have to calculate notional WDV, no big deal whatsoever. Okay. And in relation to that converted property from residence to your personal, again, I can use the same to same explanation. That is our explanation number 5, where your use of the property is changing. Okay. And now it has been introduced as your business and profession property. Previously, it was property of the assessee. Now it has been brought into the use for business and profession. So quickly, we just have to do the calculation now. Simple. Okay. So let's start with the working. Question ID number is what is the question ID number is 37. Let me check in the question again. 1 second. Yeah, this question ID number is 37. We have two properties to be dealt with. Okay. So we have one residential house and gifted property. Gifted property was 3 years back, so I'll have to do that particular calculation. So now I'm not writing every time opening, closing, opening, add, because many times that sale and all that is not there. So I'll just do it in a shortcut manner. Okay. So opening, addition. Okay. So gifted. First of all, the cost of the previous owner. Previous owner cost is 9. Okay. Nothing is sold, so I'm just ignoring. Total is 9. Depreciation on that. So I'm just doing 3 years back calculation. So that is going to be 10%. I'm just taking property 10%. Or you can just say that all these rates are assumed or something like that, so that you don't mug up the rates of depreciation. 10%. So it is 0.90. It was somewhere in the month of May, so that half rate, full rate complication is not there. Okay. So this is going to be 8.1. And this is 3 year back calculation. Now, year number 2, that means 2 years back, opening, additions. Okay. So you'll have an opening 8.1 with respect to the gifted property, and with respect to your own property, you have added 10 lakhs. Depreciation, I think this was also, just check half rate, full rate. I think it was half rate. I'll have to just reconfirm this. It was purchased 2 years back in the month of January. So month of January is going to be, first year it's going to be half the rate. Okay. So this is going to be half the rate. So it is 0.50. at the rate of 10%, but half the rate. Okay. And this is going to be normal depreciation 0.81 in relation to that. Closing WDV. This is going to be 9.5. This is going to be 7.29. Okay, so 2 years back is gone. Now again, the residential house, let me calculate the straight away depreciation only. I can calculate now 0.95. I'll do it in a little faster way. And this is 7.29, so it will be 0.73. Let me make it 73. This is going to be 8.55 and 7.29 minus this is going to be 6.56. This is what I call as a notional WDV. This is the cost of the asset. Okay. So, for the previous year, the cost of the asset, explanation 5 and explanation 2. Okay. The cost of the asset to the assessee with respect to both the properties will be 8.55 and here it is going to be 6.56. Finish. So on this cost of the asset, now henceforward I will be eligible for the purpose of depreciation. Finish. Alright, just check up all the working calculation. It's just the notional WDV calculation. No big deal whatsoever. Okay. Let me go to the next question now. Okay. How will you deal with the following issues in computation of the income from business? A company imported machinery on 15/9 of the previous year at the cost of rupees 10 crores. The customs duty payable thereon was 20%. The company claimed input credit of 1 crore. The rate of depreciation on the machinery is 15%. Assuming that it was put to use on 15th October, what is the depreciation liable on that particular machinery? See, one of the point here is that now with the introduction of the GST, appropriate clarification under Income Tax Act is still not there whether you will be eligible for the purpose of input credit under GST also and the depreciation under Income Tax Act also. But the GST law is very clear. The GST law has made it very clear that if you are claiming input credit under the GST, you will not get depreciation under the Income Tax Act. So considering the intention, you cannot get input credit under GST law and as well as the depreciation under the Income Tax Act, both is not permissible. So basically you have to choose whatever you want to do, you do it, and accordingly you have to apply this. Okay. So this is your 10 crore is your import price, duty payable, so that is going to be the part of the cost, and you are claiming the input credit 1 crore. So if you are claiming the input credit 1 crore, to that extent you will not get the depreciation. Finish. That's the main message here. And the rate of depreciation machinery is 15%. You have put to use on 15th October of the previous year. So based on that 15th October, you have to check it out whether it is half rate, full rate. Okay. So 180 number of days, you just check it. November, December, January, February, March. So 5 months. So that's going to be how many number of days put to use? Approximately 150 plus the 15 days is 165. Okay, so this is going to come in the half the rate category. Rough calculations. Okay, so quickly let's do that particular calculation now. Question ID number is, one second, what is my question ID? I've forgotten. 38. Okay. Question ID number is 38. Okay. Machinery 10 crores. Duty 20%. So 2 star. Here we have not to do the technical calculations of the customs and all that. Just straight away put 20. Input credit. Because you are already claiming, to that extent, you will not get that particular depreciation. So I'll do that particular -1. Okay, so your cost will be 11. This was one of the main message. Okay, depreciation at the rate 15%, half the rate. So this is going to be 0.83. Quickly check the calculations. Come on, use the calculator. And 10 point, how much I'm getting? 10.18 or 17. Okay, make it as 17. That rounding off. Okay. Let me go back to the question and see what the question is asking me and whether I have done that. What is the depreciation allowable on the machinery? Now here, friends, again the additional depreciation can always be thought of, but I think that I'm just ignorant about this particular one. If you say that you are into the business of manufacturing or production of article or a thing, then you will get the additional depreciation also. But I think I'm just ignoring that particular point. Or if you want to write a comment, you write a comment that however additional depreciation can also be claimed and appropriately depending on the conditions of the additional depreciation. If they're satisfied, okay, you can go for the additional depreciation also. Nothing wrong. Okay. Check out my answer. Yeah, okay.